In this next video, we'll be continuing the discussion regarding passive losses, and we left out talking about this exception to allowing passive losses to offset active or portfolio income. And this exception is only permitted for people who make less than $150,000, or I should say have AGI of less than $150,000. So this provision of $25,000 loss that can be applied against non-passive income begins to phase out when AGI reaches $100,000. And then, as I said a few minutes ago, once the AGI reaches $150,000, then they may no longer take this exception of taking passive losses against non-passive income. So, disposition of a passive activity in a transaction involves, for example, selling a passive activity. In the event that this occurs, the passive losses are allowed against non-passive income. So this is a separate exception in a way, except that in this case you actually have to dispose of the entire passive activity. And then any passive losses that are still available can be taken against non-passive income, including suspended passive losses. And again, the idea of passive losses and at-risk amounts I mentioned earlier, they'll be more clear to you when I can demonstrate some of these concepts in some of the end-of-chapter problems, which I'll be doing in a subsequent video. So, in addition to reading the chapter and studying these PowerPoint slides, I think even more importantly will be to go through some problems and demonstrate how at-risk and passive loss rules apply. But if the passive activity is disposed of incompletely, as I said, these passive losses, including suspended passive losses, can offset non-passive income. Gifts and inheritance generally do not trigger the use of passive losses. So, again, these are gifts and inheritance of passive activities. I mentioned before that there's two sets of rules that have to be considered before we can take a passive loss and against passive income. The first is the at-risk, which we talked about, and the second are these passive loss rules. And we have to complete a Form 6198 for each of these at-risk activities. And Form 8582 for all passive activities, one for all passive activities. The passive activity loss rules will come into play, will come into play when the at-risk rules are satisfied. So let me repeat that. The passive activity loss rules will come into play once the at-risk rules are satisfied. Right? So if the taxpayer does not satisfy the at-risk rules for taking a passive loss, then the passive activity loss rules would not even be considered. But as I said earlier, both tests have to be passed in order to take the passive loss against passive income. Again, I'll fill out and round out the conversation with at-risk and passive loss rules and some problems that I'll be demonstrating. So the alternative minimum taxable income, A&T formula, starts with our regular taxable income. And then we'll add any exemptions and standard deduction. We'll add or subtract any adjustment items, which I'll demonstrate. We will add tax preference items. Again, we're converting our regular taxable income. We'll deduct an AMT tax exemption amount, which is given on the bottom of page 13-30, and that depends upon the filing status, as well as the AMT base amount. And then we wind up with our alternative minimum taxable income base. And now we have to determine then, do we use the 26% tax rate or the 28%? And we can determine that based on this alternative minimum taxable income base that we just calculated. And the percentages are listed in the text. And they're listed, you can find them described on page 13-23. And even though in the text on page 1323 it says that we determine whether we use a 28% or 26% based on AMTI, actually it's the alternative minimum taxable base that we use to determine which percentage we apply. So we apply this percentage, let's say 26%, and that gives us our tentative alternative minimum tax, and then we deduct our regular tax to determine this additional AMT tax. So what are some adjustments that we have to make that are listed in the formula on the previous slide? Well, the 2017 Tax Cut and Jobs Act simplified this process a little bit so that we generally will make no adjustments if you itemize to any medical, mortgage, interest, charity, or miscellaneous deductions that on your regular Schedule A. So we don't make any adjustments. The only itemized adjustment would be for any taxes you paid. So there we will make an adjustment for AMT purposes, such as if you deducted state income tax. And taxes are limited to $10,000 on Schedule A, but there is no deduction for AMT. So this includes property taxes as well. Some of the adjustments for alternative minimum tax relate to depreciation. Again, a lot of this deals with businesses. And the rules change, as you can see, over time, these depreciation adjustments. But the ones we're going to really be focusing on are those that occurred after 1998, both for real property and for personal property, or what we call personal T. So with real property, after 1998, if the property was acquired after 1998, there is no AMT adjustment. So we can leave it the way it is. If we depreciated our tax form for example, a Schedule C business, there's no adjustment to that depreciation because it's essentially straight line. However, personal property after 1998, we do have to reduce the method from, for example, if it was 200% double declining or twice straight line, we have to reduce it to 150% declining balance for AMT purposes. So here we're losing part of our deduction for depreciation. Other adjustments, basis calculations for gains and losses. I'm going to go back a slide here. If we're making changes to our depreciation for AMT purposes, then that's going to affect any gains and losses on the subsequent disposition of these assets. So if we sell them later, that's going to affect the basis and therefore the gains and losses. Incentive stock options adjustments for K1s, which will come to you from partnerships or S corporations. Long-term contracts, generally for AMT purposes. Long-term contracts does not allow the completed contract method, so that they must use the percentage of completion method. These are the exemption amounts in that formula that we use for AMT that I mentioned that on the bottom of page 13-30. And here they're listed: single to $70,300, married filing joint 109.4 for 2018, and married filing separately down to $54,700. So this is an exemption that reduces these adjustments that we've made to our alternative minimum taxable income. These exemptions do phase out, however, and they phase out as the alternative minimum taxable income increases. And any amount in excess of $500,000 for single, $1 million for married filing joint, or $500,000 for married filing separately, then the phase out begins to occur on these exemption privileges. So if you look at these exemptions, what they really are is they're a way of narrowing the gap between our regular taxable income and our alternative minimum taxable income. And if we reduce them or eliminate them, if we're phased out of them, then we're more likely to face a larger alternative minimum tax. In the next video, I'll actually demonstrate then some of these somewhat complex concepts regarding at-risk rules, passive activity loss rules, and the alternative minimum tax.